Picture this. You own a restaurant, right? It's a busy Tuesday, the lunch rush is, well, in full swing, and suddenly your commercial walk-in freezer just completely dies.
Oh, that is an absolute nightmare.
Total nightmare. You need a $15,000 replacement by Thursday morning, or you are going to lose like every ounce of your perishable inventory. So, do you have 60 days to wait for a bank loan to get approved?
I mean, probably not.
Definitely not. So, where do you get the cash right this second? Well, to answer that, we are doing a deep dive today into a massive tug-of-war hidden in the latest 2026 financial data.
Right, and it is a massive divide. We're pulling from a pretty heavy stack of sources today.
Yeah, we've got the 2026 alternative lending market reports, real-world borrower reviews from Zogby's, legal briefings from the J. Singer Law Group, and the March 2026 Small Business Administration interest rate updates.
And when you look at all of this together, you see two completely different philosophies on how to run a business.
Exactly. Our mission today is to decode those two philosophies. We are looking at the intense debate between highly accessible capital, specifically merchant cash advances and revenue-based financing, and the established, somewhat sluggish realm of traditional bank and SBA loans.
It's the fast money versus the slow money.
You got it, and I'll lay my cards on the table early. I am championing the reality of modern business here. If you are that restaurant owner with the thawing freezer, the vital importance of speed just cannot be overstated.
I completely understand the appeal.
Fast money keeps the doors open, right? Accessibility is basically the ultimate lifeline.
Well, I'll be taking the other side of that argument.
Mm-hmm.
Because while speed is incredibly tempting in an emergency, the astronomical costs attached to that fast money can literally rot a business from the inside out. So I'll be advocating for the long-term structural sustainability of traditional loans, even if they require a lot of patience.
I mean, I hear the caution, but let's start with the reality on the ground. To understand why businesses are fleeing traditional banks, we have to look at the sheer friction of the old system.
The application process.
Exactly. Applying for a traditional business loan right now is, honestly, an absolute endurance test. It's like applying for a passport.
It is incredibly thorough, yes.
You're handing over years of historical financial audits. You need a pristine FICO score. You're drafting these detailed business plans. And then, and this is the worst part, you just wait months for an underwriter to make a decision.
Well, traditional banks are risk-averse by nature. They underwrite based on proven historical stability.
Right, but business doesn't happen in the past. Meanwhile, getting a merchant cash advance or an MCA is completely frictionless. It's like using Apple Pay.
The barrier to entry is undeniably lower.
Lenders in the alternative space, they don't care about a tax return from 2024. They basically ask you to connect your current bank account or like your Stripe processing dashboard.
Right, they want to see the real-time data.
Exactly. Their algorithms evaluate your real-time cash flow over the last 3 to 6 months. They fund you based on your actual reality today.
But that lack of friction is exactly why so many business owners fall into a trap. I mean, they mistake a frictionless application for a sound financial product.
You can't ignore the market demand, though. According to the 2026 report on employer firms we're reviewing, 74% of small businesses now prefer non-bank lenders.
74%. That is a staggering majority.
It really is. And when you look at Zogby's 2026 reviews of MCA providers, the appeal is obvious. Providers like National Funding can deposit cash into your account the exact same day.
Same day funding. Wow.
Yeah, if you're approved before noon Pacific. And others, like Credibly and Rapid Finance, they're funding up to $1 million in 24 to 48 hours.
Okay, let's unpack this a bit more.
Sure.
The mechanics of the repayment are actually quite brilliant for a fluctuating business. With a percentage-based MCA, your repayment flexes with your daily credit card sales.
Right, because they take a fixed percentage of your daily batch. Exactly. So say your restaurant has a terrible week because a blizzard shuts down the city for 4 days. Your payment automatically shrinks.
You aren't stuck with a massive fixed mortgage payment when you have zero revenue.
Right. But this raises an important question, doesn't it?
It does. Is the convenience worth risking the business? Because that flexible percentage is masking a deeply rigid financial structure.
Oh, you mean the factor rates?
Yes. Yeah. Let's break down the illusion of what they call factor rates. This is where the pricing model completely diverges from a standard bank loan.
Radically diverges.
Think of a traditional loan with an annual percentage rate, or APR, like a taxi meter. You only pay for the distance you actually ride.
Because it accounts for the time value of money.
Exactly. If you take out a 3-year loan, but you have a stellar year and pay it off in 6 months, the meter stops. You save all that future interest.
Because you only held the bank's money for a fraction of the time? Makes sense.
Precisely. But MCAs do not use an APR. They use a factor rate, which is a flat multiplier. It is the equivalent of buying a flat rate train ticket.
Okay, so
It doesn't matter if you get off at the first stop or ride it to the end of the line, the lender gets their full cut.
Wait, let me get this straight. If you take a $100,000 advance with a 1.30 factor rate, you owe exactly $130,000.
Correct.
So even if I take that 100 grand, deploy it, make a massive profit, and want to settle the debt 30 days later, I still have to write a check for the full $30,000 in fees.
You do not save a single dime for early repayment. The cost is entirely logged in from the moment you sign the contract.
Wow.
And this is where it gets dangerous. Because you are paying it back so quickly, often in 6 to 9 months, when you take that flat fee and annualize it to see what the true effective APR is, the numbers are staggering.
How staggering are we talking?
The reports show the effective APR on these advances hits anywhere from 40% to an astonishing 350%.
350%. That is insane. When you put a 350% APR next to traditional lending, it forces you to completely rethink what slow money actually means. It really does put things in perspective.
Like, looking at the Lendio data for March 2026, the Wall Street Journal prime rate is sitting at 6.75%.
Right, which sets the baseline.
And by law, the absolute maximum an SBA 7A loan over $250,000 can charge is the prime rate plus 3%, so 9.75%.
Which is incredibly low compared to the MCA.
Exactly. Suddenly, waiting 60 days for an SBA loan capped at 9.75% doesn't look like an annoying delay. It looks like a vital survival tactic.
It is the difference between scaling a business and strangling it, because the data highlights a terrifying statistic here.
What's that?
Small businesses are spending an average of 15% of their gross monthly revenue just to tread water on MCA repayments.
15% of top-line revenue. That is completely unsustainable for a business with tight margins.
Absolutely. A restaurant might only have a 10% net profit margin to begin with.
Which means they are immediately operating in the red.
Yes, and that leads directly to the mechanism that destroys these companies.
Yeah.
The daily ACH debit.
Right, the automatic withdrawals.
An ACH debit means the lender is reaching into your business operating account and pulling cash out every single business day.
Oh, man.
You wake up, and before you've even turned on the lights or poured a cup of coffee for a customer, yesterday's cash is gone.
And if you're losing 15% of your cash every morning, you eventually can't make payroll.
Exactly.
Yeah.
The business literally suffocates. It creates a brutal phenomenon known in the industry as the
debt spiral.
The debt spiral. The daily sweeps drain the operating cash, so the owner panics. What do? They take out a second merchant cash advance just to get a lump sum of cash to cover the daily payments of the first one.
Oh, wow. They call that stacking, right?
Yes. They're using a 350% loan to pay off another 350% loan.
That is just a recipe for disaster.
And once you start stacking, the daily debits compound until the business simply collapses under the weight of its own debt.
I mean, I hear the danger. A debt spiral fueled by daily automated sweeps sounds like an absolute nightmare.
It is.
But here's where it gets really interesting. We have to draw a critical distinction here because not all alternative funding operates like a predatory trap.
Fair enough.
And to understand why MCAs can get away with this, we have to unpack the legal loophole they operate through. Legally speaking, a merchant cash advance is not a loan.
Which is the core insight from that J. Singer Law Group briefing we reviewed.
It's the whole ballgame. Legally, they are structured as a purchase and sale of future receivables.
So in plain English, they aren't lending you money. They are buying a product you haven't made yet.
Exactly. If I buy your future credit card sales at a discount, the law views that as a commercial transaction, a retail sale, not a loan.
And because it's classified as a sale,
State usury laws completely vanish. Usury laws are the state-level regulations that cap how much interest a lender can legally charge a borrower.
since an MCA isn't a loan, those borrower protections simply do not apply.
Right. That specific legal classification is the only reason they can legally extract a 350% effective APR.
And the lack of loan classification strips away even more protections than just the interest rate caps.
What else do they lose?
Well, the J. Singer Law Group highlights incredibly aggressive clauses buried in these contracts. The most dangerous mechanism is called a confession of judgment, or a COJ.
A confession of judgment. That sounds terrifying.
If a business owner signs a contract with the COJ, They're essentially giving up their right to defend themselves in court before anything even goes wrong.
Wait, really? They just sign their rights away?
You are pleading guilty in advance. If you miss a payment, or if your bank account dips too low for the daily ACH sweep, the funder can take that COJ document straight to a judge.
And they get an immediate legal judgment against you.
Instantly.
Without a trial.
Without a trial, without a hearing, and often without you even knowing it's happening until it's too late.
That's wild.
They use that judgment to send a levy to your bank, and your accounts are frozen instantly. You go to buy supplies for the day, and your card declines.
It's a highly aggressive collection tactic that traditional regulated lending simply does not permit.
Never.
Okay, the legal risks of a confession of judgment and the daily cash flow drain of an MCA are intense. But this is exactly why we need to separate MCAs from pure revenue-based financing, or RBF.
They are structurally different.
Totally. The market reports show RBF has exploded into a $15.86 billion market in 2026.
It has definitely carved out a massive niche in the tech and digital retail sectors.
Yeah, it's become the gold standard for software-as-a-service companies and e-commerce brands, precisely because it fixes the toxic mechanics of the MCA.
Because the mechanics are fundamentally healthier.
Right. First, pure RBF typically takes monthly payments, or a simple percentage of monthly revenue, rather than pulling cash out of your account every single day.
That alone saves you from the daily cash flow heart attack.
Exactly. Second, they utilize totally transparent repayment caps. You usually agree to pay back 1.2 to 1.6 times what you borrowed, and they explicitly avoid aggressive tactics like confessions of judgment.
The terms are certainly more standardized.
But the real magic of RBF is that it's non-dilutive capital. Let's use an analogy here.
Okay.
Taking money from a venture capitalist is like giving away a permanent slice of your bakery's pie. As long as the bakery exists, they own that slice, and they might even demand a seat in your kitchen to tell you how to bake.
Right. You are sacrificing equity and control for cash.
Exactly. Revenue-based financing, on the other hand, is just paying someone a slice of today's pie so they leave the kitchen.
That's a great way to put it.
Once you hit that 1.2 repayment cap, the contract is over. You keep 100% of your equity, you keep your board seats, and you retain total control of the company, but you still get the massive injection of growth capital you needed.
I will grant you that pure RBF is a vastly superior, more sustainable model than an MCA. It actually aligns the investor's return with your growth trajectory.
Absolutely.
But if we connect this to the bigger picture of building a legacy business, even RBF cannot compete with the structural power of traditional lending.
You mean when it's time to make the truly massive enterprise-level moves?
Exactly. Think about our restaurant owner. If they pivot to selling their signature hot sauce online, RBF is a great tool to fund an e-commerce marketing push.
Perfect tool for it.
But what if they want to buy the actual commercial building they operate out of, so they stop paying rent forever?
Oh, yeah. That's a different game.
Or what if they want to build a massive multi-state manufacturing facility? You need capital structures designed for decades, not months.
And that is where the government-backed loans step in.
Let's look at the mechanics of the SBA 504 and 7A programs. They often require only a 10% down payment.
Just 10%.
Yes, and they offer amortization schedules up to 25 years for commercial real estate. When you stretch a multi-million-dollar principal across 25 years at a 9.75% cap,
the monthly payment drops to a level that the business's natural cash flow can actually absorb.
comfortably absorbed without breaking a sweat. It transforms a massive capital expense into a manageable operating expense.
That's huge. And the sources highlight options that go even further than the SBA, too.
They do. The USDA offers Business and Industry, or B&I, loans specifically designed to stimulate rural economies.
Right. And the reports define rural pretty broadly as populations under 50,000.
Exactly. They offer up to $25 million. But the key mechanism here is the runway.
The interest-only payments.
Yes. They offer up to 36 months of interest-only payments.
An interest-only runway of 3 years is incredible. Functionally, that means you can secure the funding, spend 2 years building a massive rural hotel, open the doors, and get the business to full profitability before you ever have to pay back a single dime of the principal loan amount.
It completely de-risks the expansion phase.
And for massive commercial real estate acquisitions, the market relies on CMBS loans, right? Commercial mortgage-backed securities.
Yes. These offer 25 to 30-year amortizations, but their defining feature is that they are non-recourse loans.
Let's define non-recourse for everyone listening, because that is a massive shield for an entrepreneur.
Non-recourse means the loan is secured solely by the commercial property itself.
So if a catastrophic market crash happens and the entire venture goes under,
The lender can foreclose and take the building, but they cannot legally pierce the corporate veil to touch your personal home, your personal bank accounts, or your life savings.
your personal wealth is totally insulated.
Compare that to the MCA's confession of judgment, where they can freeze your personal accounts instantly. It's night and day.
Okay, I concede that for building a stable, wealth-generating empire, those traditional tools are phenomenal.
They're the bedrock.
But I have to push back here, because this brings us right back to our original tug of war. So what does this all mean for Tuesday afternoon?
Well,
Everything you just listed, the SBA, the USDA runway, the CMBS non-recourse shield, that is brilliant for a 10-year master plan.
it is the bedrock of corporate finance.
It is, but it completely ignores the reality of an immediate crisis. If my walk-in freezer is actively sawing $20,000 worth of prime beef, an SBA loan that requires a 90-day underwriting process is completely, utterly useless to me.
True, it will not solve an acute 48-hour crisis.
The opportunity cost of waiting is business death, which is why using an MCA or RBF as a short-term bridge is a highly strategic, mathematically valid move.
If you treat it strictly as a bridge.
Exactly. You use the fast, expensive money to solve the immediate crisis, so long as the return on that capital or the prevention of a catastrophic loss outpaces the high cost of the funds.
You have to know exactly how the toll is calculated.
Right. If I spend $4,000 in MCA fees to immediately fix that freezer, but it saves me $20,000 in inventory and keeps my restaurant open for the weekend rush, I mean, that is a wildly profitable business decision regardless of the annualized APR.
Mathematically, yes, it serves a purpose. The fatal error occurs when business owners use that high-interest emergency bridge money to fund long-term investments.
Or when they miscalculate their ability to survive the daily automated cash sweeps. You have to match the tool to the timeline.
And that perfectly summarizes the core debate in these 2026 reports. It essentially boils down to the cost of capital versus the speed of opportunity.
The fast money provides immediate life-saving liquidity, but it comes at a premium that can choke your daily operations if you aren't strictly disciplined.
While slow money provides incredible rates, legal protections, and structural stability.
But you have to survive rigorous historical audits, put up collateral, and have the sheer patience to wait for it.
It's a trade-off.
So for you listening right now, the ultimate takeaway is structural alignment. You should never, ever finance a 10-year commercial real estate acquisition with a 6-month merchant cash advance.
The daily payments will crush your company before you even finish remodeling.
But on the flip side, you shouldn't sit around waiting 90 days for a traditional bank to approve a loan to fix a broken piece of vital equipment that is actively bleeding cash every single day it's offline.
It is all about knowing which lever to pull and exactly what happens when you pull it.
Absolutely. But before we wrap up this deep dive, I want to leave you with a completely new angle to ponder.
Oh, this is fascinating.
Yeah, it's something buried deep in the technical data of these reports. The data notes that alternative lenders are now using artificial intelligence to cut their processing times by 81%.
81%.
AI is scanning bank data to perfectly predict future cash flows and instantly price risk.
That algorithmic underwriting is exactly how they are achieving those instant, frictionless approvals.
Right. But think about the inevitable implication of that technology. If alternative lenders can perfectly price risk in 24 hours using AI, how long will it be until traditional banks buy those exact same AI models?
If traditional banks can match the speed of alternative lenders while maintaining their low rates.
Exactly. What happens when an SBA lender offering a 9% interest rate and an amortized schedule can underwrite and approve your application in 48 hours instead of 90 days?
The landscape completely changes.
Will the agonizingly slow bank loan soon become totally obsolete? And if traditional banks solve their speed problem, does that completely erase the one single advantage alternative lenders have?
It's a huge question.
We might be looking at a future where the high-interest MCA industry is literally forced into extinction by AI-powered banking. But until that day comes, if your freezer breaks on a Tuesday, well, at least you know exactly what your options are and exactly what they're going to cost you.